Folks, it's Dave Burrows. I'm CIO and CEO here at Barometer Capital Management. I want to thank everybody for joining us today. We are coming into the tail end of the earnings season, and in general, earnings have been pretty good. We like to look at the reaction to the earnings and how markets are behaving in the face of news. Tells us a lot more than the news itself. What I thought I'd do today is just take a crack at looking at the market from the top down, see some of the underlying themes, check to see if anything's changing. We like to do these because it keeps us transparent. It holds our feet to the fire because we show a lot of pictures, and the pictures have to line up with how we're positioned in portfolios, because ultimately our job is to recognize change and make sure that the portfolios make sense given the market that we're operating within. So as always, just starting from the top down, we continue to believe we're in a bull market that started in 2013. We notice that over time, there are these extended secular bull markets where markets go from being underowned after many years of underperforming to ultimately overowned and generally overpriced, which requires the market to regenerate its energy. And you see markets go through a series of more significant bear markets during secular bear markets until ultimately you make a new high and we start all over again. Generally by then, again, the market's hated and generally prices are reasonable. So we've been working our way higher here since 2013. We've just been through a 2-year cyclical bear market, started in December of 2022. In general, we know that in a structural bull market like the 80s and 90s, or the period from 2013 to the present, despite the fact that the market has painful pullbacks, we generally remain above a rising 200-week moving average. And we stopped at exactly that point in October of 2022. Won't say I wasn't worried we'd cut through it, but the reality is that structural bull markets tend to last 15, 18 years, and we're probably 10 years into the current one. The last one went up 1,317%. As we sit today, we're up about 227% since 2013. So this can go a long way. I think it's really important to continue to recognize that we have recently made a new high. And when that happens, you can always pull back, but it generally means you've entered the next business cycle. Market's looking forward 12 or 14 months. And while we're all worried about the impact of the Fed's tightening cycle and other central banks around the world, markets start to look beyond it at what may be well set up to do well through the course of the next cycle. And we're going to talk about that today. So here we are. We made our exit from that cyclical bear market. We've probably got some room to run. When we take a look at the near-term picture, we can see that we exited the beginning of January. We've had little daily pullbacks here and there, and market was down a little bit today. But in general, we're trading above all the long-term moving averages, 200-day, 150-day, the 50-day moving average, the 21-day moving average, the 9-day moving average. Market's in pretty good shape. But we like to look internally at what's going on. So we'll do that as we go along today. So if we look at a little bit longer term, this is the bear market we had in a very short order through the early part of 2020 and the COVID lows. Important lessons from every cyclical bear market. Certainly, I don't think it was the view in April that the market would race back to highs by later in the year. So you've always got to recognize price action for what it is. It's people's willingness to put money to work despite the things that they worry about. And we have to recognize it's not our opinion that matters. It's understanding what else is going on in the market. So we've had 2 weeks where the market's pulled back a little bit, not a big deal. To be honest, it wouldn't be a terrible thing if it pulled back and tested the breakout level. I'm not sure that that'll be the case, but it's possible. Sentiment certainly is getting better. I notice it talking to clients. I notice it talking to people about the market in general. People are a little bit more comfortable being invested. We can see that the consensus percent bullish investors is much stronger than it was. But notice also when you get into cyclical bull markets, it can get here and stay here. So not something to worry about necessarily that people are more bullish, just an observation, people getting a little bit more comfortable with risk. When we look at the TSX, we noted that back in December, we finally got through a bunch of the resistance that we ran into all the way through last year, leading up to October's low. And it's continued. TSX has actually been outperforming here over the last few days. And on the long-term picture, we've highlighted over the last few weeks that the TSX really looks like it just exited a very long bear market that went on from 2008 through 2020, broke out, and then consolidated while the central banks were tightening. But 1, 2, 3, 4 months in a row, market's nicely higher, and that has to do in some ways with the sector makeup. Let's talk the NASDAQ. NASDAQ had a tougher day today, down at one point about 2%, I think a little bit better late in the day. But the net of it is, there's been a couple of down days. We made a high going back about 6, 7 days ago. We're in the middle of the earnings season. Of course, tomorrow we're getting NVIDIA's earnings, and that's probably been the most important stock in the market. We'll talk a little bit about that as we go. But again, it's trading above basically all the moving averages. It's through the 9-day and in and around the 21-day. But in general, trend continues to be positive. Looking outside of North America, we're seeing some real strength in global markets for the first time in a long time. This is the Japanese market, 1991 to the present. Notice October, November, December, January, we're really moving nicely higher out of this long secular bear market. This is a lot like what happened in the US in 2013 after it hadn't made a high in 13 years, or like it did in 1951 after it hadn't made a high since 1929. It's generally the beginning of a longer-term bull market. Global stocks tend to move at different times than US stocks because the sector makeups are different. And I think it's interesting that the Japanese market's performing well, the Indian market's performing well. Look at this, up 25% in the last 4 months alone. A typical strong thrust at the beginning of a new bull market. The Euro Stoxx 50, 4 great months in a row, coming out to new highs dating back to 2007. Now, the one market that continues to disappoint is the Chinese market. In fact, if you were to look at it, it's down, I think, just about 70% from the highs. This is the CSI 300, 2016 through 2024. We're not here. And this is one market that we're avoiding. And we're not the only ones. Look at the foreign direct investment into China in 2023 versus all of the previous years going back to 1993. So something's happening there. We prefer to avoid it at this point. Just talking quickly about the bond market. Interest rates have long cycles, just like stocks do. They put in a generational low in late 1940s after the Second World War. And then rates slowly started to work their way higher as inflation and reflation in the economy picked up as the baby boom got going. And if we look at it as we sit today here, the generational low probably was in 2020. We moved sharply higher. And when we look at the long-term picture of bond yields, it's been a series of higher highs and higher lows. So rates are in a bull market, which means bonds are probably in a bear market. This is the aggregate bond index made up of various issuers and maturities. And you can see the price of bonds has steadily been falling since 2020, lower lows and lower highs. At this point, not that interesting. So when rates start to rise, generally power goes into the hands of the lender, not the borrower. So we prefer to stay away from the bond market at this point. We've got some small holdings in a couple of mandates that have to have fixed income. But in general, this has been a place we've been sort of negative on now for many, many months. Stocks versus bonds. This is comparing the SPDR, SPY, S&P 500 ETF to the aggregate bond ETF. And you can see it continually moving from the lower left to the upper right. That means that stocks are outperforming bonds, and that just continues to be the case. Commodities, after putting in a low in 2020, had a very sharp rally, and they've kind of been consolidating over the last number of months. This is the last 6 months. We got up above recent trend. We'll see whether that can get going. Probably it's going to take, a little bit more consensus that we're going to get a rate cut. And we want to see confirmation that the industrial economy stays strong. Industrial companies have really been outperforming. Now, when we look at REITs or the real estate sector, this is really the only thing that matters right now. This is relative strength versus the S&P 500. When this line is falling, it means it's underperforming. Borrowers versus lenders. Real estate and generally borrows to make their investments. It's a levered asset. The REIT index is still down about 27% over the last 557 days. And not showing any real change on a relative basis versus the S&P. So this is an asset class we want to avoid. So in general, we're positive on equities. We're positive on basic materials and commodities. Not so positive on fixed income. Not so positive on real estate. Not positive on things that do poorly when rates are going higher. Okay, so year to date, equal weight S&P is up about 1.4% as of Friday. TSX up about 1.75%. The aggregate bond index down 1.8. So bonds negative. Our equity strategy up about 7%. Our income strategy, which is more dividend growth focused, up about 5%. And our balanced mandate up about 2.6, probably being held back a little bit by the fixed income weight that it has to carry as a balanced mandate. So over the last week, we got some more earnings. We're now 396 of the S&P 500 reported. On aggregate, sales growth has been about 3.5%, earnings growth about 5%. I think what's more important is that revenues are surprising versus the estimates, and earnings are coming in about 7% ahead of the analyst estimates. So in general, companies are beating. When we looked at the jobless claims, interesting worry that higher rates is going to impact labor markets. We've had jobless claims come down over the last 2 weeks, jobs staying strong. And it would make sense then that consumer confidence is pretty strong. University of Michigan consumer expectations has been moving higher over the last number of months. In fact, we're at a 31-month high in consumer expectations, and their estimate of current conditions also moving sharply higher. So the consumer seems to be in pretty good shape despite the higher rates. Now, we don't have to be everywhere. Our job is to try and target parts of the market that we think have a structural tailwind, things that can be revalued, not just that can grow their earnings, but where investors recognizing the future is looking a little brighter might be willing to pay a higher multiple of earnings. So our job is to identify market leadership, and that could be specific sectors or themes or geographic regions that we want to focus our attention in. We're always watching for change, new leadership to emerge or old leadership to recede, so we can adjust the portfolios accordingly. And in the absence of leadership, we're very happy to hold cash. Now, as it stands right now, we're reasonably fully invested, but it is tactical and there is a time to play defense. If I put our 10 best clients around a table, everyone has a hope that they're going to make some returns on their investments. The biggest fear is having a big give up. So our number one job is to make sure that little mistakes don't turn into big ones. Part of that is being disciplined as a seller. Part of it is recognizing there's a time to be a little bit more offensive, as we have been recently, and there's a time to be a little bit more defensive. In truth, 70% of return comes from being in the right asset classes. We think right now that includes equities and some materials, and finding the sectors and themes that are benefiting in the current environment. 30% of return comes at the hands of finding the right security to use to express your view. So I focus on our top-down work, trying to identify those themes we want to focus in, and it won't be all the sectors all the time. And then our research team looks through 60,000 securities to drill down to individual portfolios that might be 30 or 40 positions. And we're looking for situations that are good, getting better, strong to begin with, high quality securities where we can see something's changing for the better. And that can lead to multiple revision or multiples expanding, where investors over time are willing to pay a higher multiple of the earnings because they believe the future looks better. So our portfolios are made up of these factors. Now, this is a living, breathing universe. It changes sometimes quickly, and we have to be prepared to readjust. And so the third piece of the strategy, which I think is probably the most important part, is a very disciplined selling strategy. Now, using stop losses is valuable for two reasons. One, because it makes sure that little mistakes turn into big ones. Sometimes things you expected just don't work out. But on the other hand, it lets us stay in positions as long as they continue to work. And that's actually an important factor this week. We're always looking for parts of the market from a top down, where over time, a higher and higher percentage of stocks are participating in a rally. That means buying is spreading to more and more securities. People have conviction. On the other hand, when we see leading groups in the market where the leaders are carrying on, but the weaklings have started to peel away, that tells us we should be a little more cautious. Short-term weakness can turn into longer-term weakness. When we see deteriorating breadth, it means that we stop putting on new positions. We tighten up the stops on existing positions. And if money comes out of that group, it stays in cash. So that's an important concept. As we sit today, the percent of stocks in uptrends in Canada and globally has been expanding pretty consistently over the last number of weeks. In the US, over the last 3-4 weeks, we've seen a little bit of deterioration in certain parts of the market. When we look at the short-term indicators, percent of stocks trading above their 50-day moving average, so how they've done relative to the last 50 days, we've seen expansion in those short-term indicators. When we look at the percent of stocks with upward trajectory or positive weekly price momentum in the US, it's been expanding. That's healthy. The percent of stocks making new highs versus new lows also has been expanding. And the percent of stocks trading above their 30-week or 150-day moving average also is improving. So those are pretty good shock absorbers underneath the surface for the market itself. But we're going to have corrections, and I'm sure we will at some point this year. We generally have 2 or 3, 5% mild corrections a year. Sometimes you get a 10%er at some point during the year. This time of year is generally seasonally strong because flows are good, but we recognize it's not going to be a straight up move. One of the things that we talked about today is that when we look at the NASDAQ 100, the percent of stocks in uptrends has been backing off a little, and today was down almost 8%. So if there's 100 companies in the NASDAQ 100, we know that the percent of stocks in uptrends has contracted a little bit. So let's talk about that. Over the past week, materials, energy, financials, utilities, healthcare, and industrials were the strongest groups. On the weak side, this is different than it's been in the last little bit. Tech up to today was down about 2.46% over the past week, and of course, we're a little weaker today. When we look at the percent of stocks in uptrends in the NASDAQ 100, at the end of December, 86% or 86 out of 100 were in clearly defined upward price trends, higher highs and higher lows. Since the end of December, that has come down. As of this morning, was at 68%. And through the day today, pulled back another 8% to take us down closer to 60. So we've gone from 86% of stocks in uptrends to 60% of stocks in uptrends. That's enough for us to think about, what it is that means. Well, for one, because it's been weakening, you will have noted over the last few weeks, we haven't increased our exposure to technology, and we are underweight. In the NASDAQ 100, in the S&P, about 30% of the weight is technology. We've been about 18%, and it's a little bit lower today. So this is the XLK, which is the large cap technology ETF. You can see a little bit weaker relative price performance versus the market over the last 6 weeks. We moved lower, rallied a bit to a lower high, and moved a little bit lower today. Something just to keep an eye on. We talked last week about the fact that our holdings have been sort of high graded within technology. Our tech weight has performed pretty well over the course of the year so far relative to the large cap index. But there has been some weakness in some areas. The first thing that we reduced in December was Apple. And you can see that Apple made a high in December, a lower high in January, then a lower low, then a lower high, and we made another lower low today. So this is one big company that we made an exit on. An obvious company that we're watching is NVIDIA. Now, we've been very fortunate. NVIDIA was one of the first tech stocks to break out. Going back to the early part of 2023, we made our first purchase at $190. Now look at the way it stayed above the long-term moving averages and marched higher and higher highs and higher lows. And particularly so far in 2024, there's lots of optimism around AI. When they reported their June quarter, we had a big gap higher in price, which held. That's really positive. And it's not to say that there's anything wrong here, other than we've become very stretched, about 60% above the 150-day moving average. It wouldn't be an unusual thing to come in. It's going to report earnings tomorrow. This has become a pretty big position in portfolios. So as of this morning, we carved back our weight. We maintained weights between 3.5% and 4% of portfolios, but took the position size down. We'll see what happens. My guess is likely they'll report a great number and the stock will move its way higher. But we do use these stops to try and make sure that we don't give up, sizable returns. So we'll see. When we look at the rest of technology, when we look at the more junior technology, the ARC Innovation ETF is a great proxy. This has had a huge run up through 2020, had a move lower almost 80% during 2022 and 23. I will note that while many of the big sectors are through into new highs, this is still 69% below the highs from 2020. So again, early stage technology companies are consumers of capital, right? They need money, and borrowers don't do well in a period of higher rates. This is an area sort of we've been avoiding. So some large cap, high grade companies we focused on, some we've avoided. Moving on. We've talked a lot about financials over the last while. Financials having gone through a long bear market from 2007 through 2021. We consolidated while the Fed was raising rates. But look at this, boom, 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 boom. 4 great months in a row. And in the scheme of things, not a big deal, other than it looks like we're in a new bull market. We talked over the last few weeks about the fact that just about 100% of the companies in the financial sector are in uptrends. And since the end of November, the financial sector is up 25.5%. That includes banks, it includes insurance companies, it includes some of the fintech companies. But these are companies that are lenders, not borrowers. As rates go higher, they have an opportunity to make a better spread. In an insurance company, as rates go higher, their bond portfolio generates higher interest income for the portfolio. So in general, a reflationary environment is good for financials, which is why it's the biggest sectoral weight that we have across the firm. Industrials continue to act really, really well since the October lows. But, interestingly, they made their low about 3 months before the market made its low in October of 22 and has been outperforming ever since. Industrials relative to the S&P 500 are trading at a new relative high. So we're in a healthy market because in not just one sector driving returns. There's returns to be had in a bunch of different groups. And I would argue in general, industrials and financials are underowned relative to other parts of the market. Now, just to touch on Howmet for a second, because we talked about that last week, wound up reporting great earnings, had a great follow through, trading now better than 90% of companies in the S&P 500. Materials backed off a little bit this week. This is the uranium ETF URA. It's moved a little lower. We reduced our weight here in uranium. I think ultimately it's probably going higher, but into a bit of a correction. Metals and miners have backed off a little bit over the last few weeks. Again, still looking very, very positive longer term. We'll look to see this uptrend resume before we add more positions here. And energy in the last week actually got above some resistance. So we'll see whether the seasonal strength kicks in here. Pharmaceuticals over the last week had a very long, very nice move. We came out of a 7-year base. They're moving sharply higher. This is on the back of the GLP-1 drugs. Lilly in particular looks very strong. So in general, more economically sensitive groups are acting better than defensives. So 3 quick tests. Consumer discretionary versus consumer staples has been rising steadily, all the way through 2023 and 24. That's voting offense versus defense. Consumer discretionary tends to be a more offense-driven sector, driven by consumer confidence. Consumer staples, more defensive, sort of the need to have. So market is favoring discretionary over staples. Market is favoring financials versus REITs, right? Lenders versus borrowers. And the market's favoring transports versus utilities. And they've been doing that through the course of time, recently haven't broken out to the upside. All of these things continue to give us confidence that the market's early stage in a cyclical bull market. So what does it all mean? Well, financials continue to be our largest weight, and this has been static over the last number of weeks. About 25% of the total firm exposure to equities is in financials, and it's about double the weight of the S&P. Our technology weight came down a little bit. Well, frankly, the positions went up over the week, but we trimmed about 3% from current weights. Industrials continues to grow as a portion of our holdings and a significant overweight. Energy's overweight, consumer staples underweight. And if we go to the bottom end of the sphere, utilities really non-existent, real estate non-existent. Government bonds, a very small part of the portfolio in our balanced mandates. And then consumer in general, we have generally small weights too. So we're in an interesting market. There's a lot of dispersion, haves and have-nots. We think that there's a real opportunity to be an active manager as opposed to the consensus, which is just buy the market ETF and hope the stocks go up. Last few things to take away. We continue to have positive flows over the next 3 months that should be supportive of equities. Second, as we come out of the earnings period, corporate buybacks should re-accelerate and likely act as a cushion to any profit taking that takes place in the market. Bond investors continue not to be concerned with credit risk as they are demanding less and less premium to buy a corporate obligation versus a government obligation. If they were concerned with credit quality, this would be a rising line, meaning they're asking for more return to take corporate risk. In fact, it looks like bond investors would prefer to have corporate risk. When we look at credit spreads in financials, we note that while the financial sector is improving from a market perspective, the spreads that bond investors are expecting from financials has been falling. That means they aren't thinking there's some big bad bugaboo out there in the market that could impact financial services. And then volatility. We've noted over the last few weeks that volatility tends to be muted during cyclical bull markets, and our volatility readings are right back in the lower end of the bound. So breadth readings look pretty good. Consumer confidence looks pretty good. Short-term indicators look pretty good. Earnings look pretty good. There's a lot of money on the sidelines that can work its way to get back into the market, and we watch for any sign that things could get more difficult. But at this point, we truly believe we're very early in a new cyclical bull market, and we think that in general, investors will buy any dips in this market currently. We'll watch for change, but as it is, we're comfortable with the risk that we've taken on, and we'll monitor it day by day. So that's a short webcast for today. It'll be interesting to see how NVIDIA's numbers come out and how the market reacts. My guess is they'll probably be pretty good, but we thought maybe it made some sense just to trim a little bit. I'm just going to take a look. I don't have a moderator today, so we'll just take a look and see what questions. I got a question from Vern Ledlow. And his question is there an update on how the Barometer Music Fund is performing? Well, I haven't talked about it for a little while, but the Barometer Music Fund has continued to grow. So for those that don't know, we buy portfolios of songwriters' copyrights. And we like those assets because every time a song gets played, whether it's on a radio or through Spotify or Apple Music or on TikTok or Instagram, we get paid. The portfolio that we have about $120 million portfolio of copyrights. I think that we own something like 7 of the top 20 stream songs in history. And the portfolio's performing as expected. In the first 2 years, it paid out just a little over net to investors 7% in income and appreciated 5% in the first year. We appreciated about 4% the second year. The valuations actually have come in higher than that, but we've held back the valuations. Our competitors are in public markets. Their portfolios trade in public markets at about 19 times their cash flow. And we have our portfolio currently valued at 12 times cash flow. We want to be a little bit conservative about that, but ultimately at some point, a Universal Music would probably be interested in owning the portfolio copyrights that we have. So it's been a really nice, consistent income investment. Thanks for asking. It's gone quite well. Bob asked a question. You seem to be suggesting interest rates are going to increase from here over the longer term, hence avoiding REITs and other interest-sensitive investments. How high and for how long is your best guess? So let's just take a look at that picture we looked at earlier. Let's see here. If I can just zip back to the beginning. Here we go. Okay, so let's just use this as an example. You can see in the late 1940s, beginning 1950s, you got a sharp move up in rates. And then you had a recession, 1951, 52. Rates pulled back a little, but no, they pulled back to a higher low. Then over the next 5 years, they worked their way higher again. And then another cyclical decline. Higher cyclical decline, higher. My guess is that rates at some point in here back off a little, but it probably will help other assets more than it will help bonds. So there can be tactical trades in fixed income and things that act like fixed income. We call them bond proxies. But, rates backed off from March of 2023 through the fall. Bonds went up about 2%, and dividend growth ETFs went up over 10%. So we think that in general, there's a lot of people who own fixed income who have been losing money now for 3 years. And we think at least some of them are going to recognize that when inflation is a little more sticky, you probably want to have something that pays you more over time. So we're focused on companies that have a propensity to increase their dividend, because a rising stream of income would be a lot better to have than fixed income when there's sticky inflation. So long term, my guess is rates probably go higher for the next 15 or 20 years. I mean, that is the history of what happens. When they start to rise, they tend to rise for a long time. But we'll see. This is a macro backdrop we want to make sure we're positioned against. In general, we think that bonds are going to have a hard time making money going forward. And next question from Lawrence. What is the smallest equity in the music fund? It may be what is the smallest investment in the music fund. We have investors who are at Barometer where we have sort of 5% of their portfolio focused in music. And on a smaller account, it might be a relatively small size. In general, for people outside Barometer, there's $150,000 minimum. But for clients of Barometer, it can be less. And we have, it's public record. The Rogers family are founding investors, and We have the Slate Music Group as a founding investor, so they're obviously much bigger. So we have a broad range of size of investors in the fund. So I want to thank everybody for joining today. Hopefully these things are useful. If you've got topics you'd love us to cover, please, send us a message, give us a call. If you're too shy to ask a question online, then that's fine. We're happy to take calls one-on-one, and we'll keep doing this every week. So thanks everybody for tuning in. We'll see you again next week.